All right, let's just jump right in. Welcome to this explainer, where today we are unpacking something absolutely fascinating. We're looking at a brand new research paper on what's being called the AI broker. We're going to see exactly how artificial intelligence is completely revolutionizing the trading world by building a bridge between modern prediction markets and traditional Wall Street stocks. So if you've ever wondered how the so-called wisdom of the crowd on internet betting platforms could possibly predict the next massive move in tech stocks or commodities, well, you are definitely in the right place. To understand why AI is suddenly so obsessed with prediction markets, we really have to look at the sheer scale of the money involved here. We're talking a massive monthly trading volume of $10 to $13 billion. That's billion with a B. That is the kind of volume we're seeing processed on platforms like Polymarket and Kalshi as of late 2024. This is just mind-boggling year-over-year growth. We are no longer talking about some niche internet hobby for crypto nerds, right? This is a highly liquid, multi-billion-dollar data engine where retail traders and Wall Street pros alike are putting serious money on the line to predict real-world outcomes.
But this massive growth brings up a pretty massive problem. And it's one that this quote from the AI broker research paper absolutely hits the nail on the head about. The core issue with these prediction platforms today is figuring out how to mathematically distinguish between forecasters who possess genuine predictive skill versus the ones who are just benefiting from transient luck. I mean, sure, there are leaderboards, but those usually just rank who made the most profit. They don't actually tell us if that profit came from a carefully calculated thesis or if a trader just got incredibly lucky on some wild high-variance bet. So, how do we systematically separate the true market geniuses from the gamblers?
Well, that is exactly what the AI broker system solves, and here's how we're going to break it down in our explainer today. First, finding true super forecasters. Second, Kalshi and Polymarket strategies. Third, stock and ETF correlations. And finally, number 4, technical trading strategies. Starting off with section 1, finding true super forecasters. Because before the AI can even think about making a trade, it needs to find the signal in all that noise. It has to identify the elite talent on these platforms. So the researchers solved this whole skill versus luck problem by inventing a brand new metric which they call the Forecaster Trust Score. Now, standard leaderboards might just look at who got lucky betting on, say, a pop star's breakup. But this trust score, it requires 3 very specific things. First is your per-trade quality, which is essentially your Sharpe ratio, or your edge per unit of risk. Second is your consistency. If your returns are jumping all over the place and wildly volatile, your score gets heavily penalized. And third, and honestly this is absolutely crucial, your sample size. To really see why sample size matters, let's compare these 2 profiles directly. Take a look at Forecaster P3. They have a Sharpe ratio of 0.49, which is a really solid per-trade return. But now, compare them to Forecaster P9. P9 actually has a slightly lower Sharpe ratio of 0.43, yet they have a massively superior trust score, 4.09, compared to P3's 2.47. Why is that? Well, it all comes down to the total trades. P9 has 90 trades under their belt, while P3 only has 25. The mathematical formula actually penalizes small sample sizes because, logically, confidence grows with more data. P9 has proven their edge consistently over a much longer timeline. They aren't just getting lucky, they are legitimately skilled. Moving on to section 2, Kalshi and Polymarket strategies. Once the system actually identifies these top-tier super forecasters, how does it deploy capital on platforms like Kalshi and Polymarket? Let's dive into the AI's tactical strategies.
Here's the thing, the AI broker doesn't just blindly copy what humans are doing. It actually generates its own predictions using something called a multi-agent debate protocol. You can kind of think of this like a high-speed adversarial courtroom, literally living inside the machine. In step 1, opening arguments, an AI bull agent and an AI bear agent are fed the exact same data, and they independently build their strongest cases for and against a market outcome. Then, in step 2, the rebuttal, they read each other's arguments and just relentlessly attack the opponent's weakest claims. Finally, in step 3, a synthesis agent steps in as the facilitator, reviews the whole debate, finds the consensus, and assigns a final mathematical probability. And get this, according to the research, this adversarial setup forces the models to consider alternative hypothesis, which boosts reasoning accuracy by an incredible 30 to 50%. No way, right? That's huge.
So putting it all together, the AI broker is deploying a really smart multi-pronged strategy on these prediction markets. First up, elite copy trading. This is just aggregating the signals from those top 50 human super forecasters we talked about, the ones with the trust score over 3.0. Then, they run those multi-agent debate forecasts we just looked at to get risk-managed predictions. And finally, relationship arbitrage. This is basically finding and trading mispriced correlations between different prediction markets. And backtesting these strategies across 2024 data showed phenomenal results. The elite copy trading strategy all by itself yielded a 29.4% risk-adjusted return. I mean, that is a real game changer. Okay, let's jump to section 3, stock and ETF correlations. This is where the explainer gets incredibly exciting, because the AI doesn't stop at prediction markets. It takes these signals and applies them to traditional Wall Street equities and ETFs. The cross-market correlation the AI is hunting for here is absolutely fascinating. It's like a giant puzzle. Take a prediction market signal. Let's say the crowd and the AI give a 65% probability that the Federal Reserve is going to cut interest rates 3 or more times. Well, the AI knows that a macro event like this doesn't just happen in a vacuum. It triggers a domino effect.
First, an intermediate effect like higher overall tech valuations, which then leads to the final stock impact, increased infrastructure spending, pushing a stock like Nvidia up, say, 18%. Because the AI is constantly monitoring the elite macro forecasters on platforms like Polymarket, it's actually getting this signal 45 to 60 days in advance of the broader stock market fully pricing it in. It's literally seeing the future before the rest of Wall Street catches on.
Let's look at another example of how it discovers these relationships, but this time on a global scale. If prediction markets are signaling a 52% chance that China's GDP growth is going to exceed expectations, the AI immediately correlates that to a massive surge in copper and iron ore demand. And the resulting stock impact? Traditional mining giants like BHP and Rio Tinto see a 20% jump. By copying the top China economic experts over in the prediction markets, the AI is giving traditional ETF and equity traders a 2 to 3 month lead on commodity stock movements.
But what happens when we're dealing with really complex assets, like Tesla? Well, the AI weaves all these individual threads together into complex, multi-factor prediction models. It isn't just staring at a single price chart. It is actively looking at live probabilities across 5 completely different prediction markets. It's asking, what are the odds EV tax credits get extended through 2026? Will Elon Musk step down as CEO in 2025? Is China's EV sales growth dropping below 10%? What are interest rates doing? Are oil prices pushing past $100 a barrel? The system takes the probabilities of all these specific events, some of which are bullish, some bearish, and synthesizes the whole shebang into one highly calculated forecast. In the paper-specific example, this multi-factor model yielded a 58% probability that Tesla would outperform the broader market over a 6-month period.
And it does the exact same thing for the financial sector. Take JP Morgan, for instance. The AI aggregates signals from Correlate and Polymarket regarding rate cuts, the odds of a U.S. recession in 2025, regional bank failures, the risk of commercial real estate defaults hitting over $50 billion, and even investment banking M&A activity. It takes all of that macroeconomic noise and distills it down into a precise, mathematically weighted forecast for JP Morgan stock. By the time this news actually hits traditional media outlets, the AI has already positioned itself based on the early intelligence gathered from those super forecasters.
All right, section 4, technical trading strategies. Because, having the right fundamental thesis is really only half the battle. You still have to execute the trade at the right time. Now, you might be thinking that an AI this insanely advanced would just completely abandon old-school technical indicators, right? But that actually couldn't be further from the truth. Yes, even a cutting-edge AI still relies on plain old charts for timing, just like you'd see on TradingView. The researchers tested over 50 technical indicators on 2024 data to see what actually works. And the results? Plain old RSI, the relative strength index, achieved a massive 79.4% win rate during range-bound consolidation periods. Bollinger Bands hit 77.8% for mean reversion trades, and Donchian channels delivered 74.1% when confirming breakouts. The AI is perfectly pairing its next-gen prediction market fundamentals with these time-tested technical signals to manage its entries and exits.
And honestly, that brings us to some very grounded foundational wisdom buried at the very end of the AI Broker research paper. It simply says, consistency beats complexity. Manage risk first, profits follow. Even with a sophisticated multi-agent LLM debate protocol, and even with the ability to basically scrape the brains of the top 50 super forecasters on the internet, the AI still relies on basic, fundamental risk management. No single indicator or market signal is pure magic. It's the disciplined, systematic aggregation of small edges that ultimately creates those outsized returns.
Which leaves us with this final provocative thought. We've seen how the AI broker takes the collective human intelligence of prediction markets, mathematically filters out the lucky gamblers, and perfectly times its trades on Wall Street using traditional technical charts. It is a system built by humans, to analyze humans, to ultimately out-trade humans. So as these AI agents become more and more sophisticated at decoding the markets, will human intuition remain an essential edge in finance? Or is our intuition destined to become just another outdated data point in the machine's model? Let that sink in for a minute. Thanks so much for joining me on this explainer, and I'll catch you on the next one.
So, if I told you the ultimate financial super forecaster isn't a Wall Street veteran with, decades of experience, and it isn't some massive supercomputer crunching numbers in a dark room, it's actually, it's the two of them, sitting at a virtual table just actively arguing with each other. Welcome to the deep dive.
Yeah, it really is a fascinating dynamic to uncover. I mean, we were looking at a fundamental shift in how we measure intelligence, both human and artificial.
Exactly. And to really grasp the scale of this for everyone listening, you have to picture the financial landscape shifting right under our feet in late 2024 and early 2025.
Oh, an absolute gold rush.
Total gold rush. We saw prediction markets like Polymarket and Kalshi just explode out of nowhere. We are talking about platforms suddenly handling $10 to $13 billion in monthly trading volume.
Which is staggering.
Right. And the demographics shifted almost overnight. You had your everyday retail trader sitting on their couches, sure, but suddenly you also had over 400 Wall Street professionals actively trading on these platforms.
Yeah, the institutional money arrived.
Literally billions of dollars flying around, betting on everything from interest rate cuts to election outcomes to, box office numbers. But with all that money moving at lightning speed, a massive structural problem emerged.
Because when you introduce that much volume and that many new participants into an ecosystem, the noise becomes entirely deafening.
Yeah.
You have a leaderboard full of people making millions of dollars, and the immediate assumption is that the people at the top are just geniuses.
And that is the core issue, right? Like, how do you actually know if a winning trader, the person flashing a massive return on that leaderboard, is a genuine super forecaster with real repeatable skill?
Right, exactly.
Because they could just be an insanely overconfident gambler who happened to get, lucky on a massive high variance bet. If you are trying to follow the smart money, confusing luck with skill is a very fast way to go bankrupt.
It is. And historically, the financial industry has really struggled to quantify that difference in real time. We tend to look at profit and loss, maybe a win rate, and just call it a day.
Yeah, which makes sense on the surface.
It does. But those metrics reward reckless behavior. They reward the person taking the biggest swings, not the person making the most accurate predictions.
Which brings us to the source material for our deep dive today. We're looking at a research paper published on January 1st, 2026 by researcher Alex Gahn.
A really groundbreaking paper.
Yeah, it centers on this new platform called the AI Broker. And what this paper does is lay out a systematic way to hunt down those true super forecasters and predict complex financial outcomes.
And the methodology is wild.
It is. They do it using a very unexpected mix of multi-agent large language models, literal AI on AI adversarial debates, and some seriously complex mathematics.
It represents a brilliant synthesis of different disciplines. You have institutional grade market intelligence colliding with behavioral psychology and advanced artificial intelligence.
Yeah.
The goal of the AI broker isn't just to build a better trading algorithm. The goal is to build a system that fundamentally understands who to trust, and more importantly, the mathematical mechanics of why they should be trusted.
Let's start with that trust mechanic, because the paper makes a really strong case that current prediction market leaderboards are just deeply flawed.
Oh, completely.
They basically just track overall profit or raw win rate. So if I make one massive, highly improbable bet and it happens to hit, I shoot to the top of the leaderboard based purely on profit.
Even if it was a terrible bet to make at the time.
Right. I look like a savant to everyone else on the platform, but my actual forecasting skill might be virtually zero. I just, bought a winning lottery ticket.
It creates a totally perverse incentive structure. The AI broker solves this with a mathematical filter called the Forecaster Trust Score.
Okay.
It evaluates performance across 3 distinct, rigorous components to just strip away that illusion of luck. The first component is per trade quality.
Meaning what exactly?
This is your underlying edge, often measured by the Sharpe ratio. It basically asks, for every unit of risk you take, how much reward are you consistently capturing?
It's like baseball, right? Hitting a home run on your very first at bat in the majors is impressive, but it doesn't mean you're a better player than the veteran with a solid batting average over 5 seasons.
That's a perfect analogy.
But, okay, let's unpack this. How exactly do you quantify trust in a purely mathematical way? Because a gambler can have a high edge on a single lucky roll of the dice.
What's fascinating here is how the formula layers its defenses. So the second component is consistency. Mathematically, this looks at the standard deviation of your returns.
So how bumpy the ride is.
Exactly. Are your wins and losses swinging wildly all over the place? Or is there a tight, reliable pattern to your performance? A true expert doesn't blow up their account one week and double it the next. They compound steadily.
Okay, so we have quality and consistency, but I mean, those two alone still don't completely solve the lottery ticket problem. A guy could have 2 incredibly lucky, highly consistent wins and still be a total fluke. How does the math catch that?
This is where the third component comes in, and it is the real game changer. It's called sample size confidence.
Sample size confidence.
Yeah, the formula incorporates the square root of the total number of trades you've made. This is rooted in standard error theory.
Standard error theory sounds like something I totally slept through in college statistics. How does that actually work in this context?
Think of standard error as a measure of how much we can trust an average. If you flip a coin 2 times and it lands on heads twice, the average says the coin lands on heads 100% of the time.
Right, which is obviously false.
Because the standard error is massive there, since the sample is tiny. But if you flip it 10,000 times, the average will settle right around 50%. The standard error shrinks.
Oh, I see.
The AI broker uses this concept to mathematically penalize forecasters with only a few trades and heavily reward those who have proven their edge over a substantial track record.
But wait, a purely mathematical score like that can't account for a massive, unprecedented black swan event, can it?
Yeah.
Like if I'm a trader and a global pandemic hits, the math doesn't know that. Doesn't standard error just assume everything follows a normal distribution?
That is a really critical observation. Standard error theory does assume a level of normality, but what the AI broker does is continuously recalculate that consistency metric, the standard deviation.
Oh, so it updates in real time.
Yes. If a black swan event hits and a trader's returns suddenly swing wildly, their consistency score plummets, which drags down their overall trust score. The system demands that a true super forecaster navigates the black swan smoothly to maintain their high rating.
Let's look at the concrete data from the paper to see this in action because it really clarifies things.
Let's do it.
So the researchers tracked a trader designated as forecaster P3. Now P3 has a massive per trade edge. Their Sharpe ratio is 0.49, which is fantastic in any market.
Incredible.
But P3 has only made 25 trades. So when you run P3 through the AI broker's formula, they only get a mediocre forecaster trust score of 2.47.
Because the math is effectively saying your edge looks great, but 25 trades just isn't enough data to prove you weren't just riding a short-term market trend. Contrast that with forecaster P9. P9 actually has a lower edge per trade, a Sharpe ratio of 0.43 compared to P3's 0.49.
So worse per trade.
Yes, but P9 has made 90 trades. Because of that massive sample size confidence driving down the standard error, P9 gets the highest trust score of the dataset, a 4.09.
The system recognizes that P9 has proven their skill over a long enough timeline to just rule out pure luck. But there's another example in the data that I think is even more revealing. Forecaster P10.
Yes, P10.
P10 has a decent sample size, 35 trades, but P10 has absolutely zero edge. Their wins and losses basically cancel out to nothing.
And the system handles P10 beautifully. It gives P10 a forecaster trust score of exactly 0.
Zero. Wow.
Because the math dictates no amount of sample size can save a 0 edge. If you don't have underlying skill, doing the same thing 100 more times won't magically generate trust.
So the AI broker has its human tracking mechanism. It mathematically isolates the true super forecasters by filtering out the gamblers and the noise. But knowing who the smart humans are is really only the first piece of the puzzle.
Right, that's just the input.
Exactly. The paper moves from who the system trusts to how the machine itself actually reasons. Let's look under the hood at the AI broker's 5-layer architecture.
The heavy lifting really happens in the first two layers. Layer 1 is the analyst team. But this isn't a team of humans, it is a system of parallel specialized agents. You have 4 independent AI models, each strictly confined to a specific domain.
It's like putting blinders on them so they only see their specific slice of the market.
Precisely. The fundamental analyst is purely looking at on-chain metrics, institutional adoption rates, and regulatory filings.
Okay.
The sentiment analyst is processing social media panic, news tone, and whale wallet activity. The technical analyst is scanning dozens of chart patterns, moving averages, and momentum indicators.
You're covering all the bases.
And the macro analyst is evaluating Federal Reserve policy, inflation data, and broad geopolitical events. They all operate simultaneously, processing massive amounts of data without ever influencing each other.
So they each produce their own independent, highly specialized report. And then all 4 of those reports get handed up to Layer 2, the researcher team.
Yes.
And this is where the paper introduces a wild concept. Layer 2 employs an adversarial debate mechanism. It forces a bull agent, an AI, prompted to argue that the asset price will go up, and a bear agent prompted to argue the price will go down to debate each other over 3 structured rounds using the reports from Layer 1.
It's a brilliant setup.
But wait, we're programming AIs to fight with each other. If I ask an AI a question, I just want the most accurate answer. Doesn't forcing them to argue just create unnecessary noise and confusion?
If we connect this to the bigger picture, you have to look at how large language models are actually trained. They undergo something called reinforcement learning from human feedback, or RLHF.
Right, to make them safe and helpful.
Exactly. But because of this training, LLMs are inherent people pleasers. They're essentially sycophants. If you ask a standard model to build a case for why an asset will go up, it will gladly find every piece of evidence to support that bullish case and completely ignore the bearish evidence, just to satisfy your prompt.
Oh, wow. So it is pure confirmation bias.
Pure confirmation bias. So by forcing an adversarial framework, you're essentially hacking the AI to break its natural programming. You are forcing it to acknowledge the counterarguments.
It forces active open-mindedness.
Yes. In round 1, the bull and bear agents independently build their strongest opening arguments. In round 2, they swap arguments and are forced to produce point-by-point rebuttals of their opponent's weakest assumptions.
They literally have to tear each other's logic apart.
Exactly. Finally, in round 3, a third AI, the debate facilitator, steps in. It synthesizes the arguments, identifies the core disagreements, and assigns a final probability of the outcome.
And the paper makes a stunning claim here. Forcing the models into this multi-round adversarial debate actually improves their reasoning accuracy by 30 to 50%.
It's a massive jump in performance.
Just by making them argue, you strip away the hallucinations and the sycophantic assumptions, but how are they actually grading that accuracy? The paper introduces a specific metric at Layer 3 to judge these debates.
Yeah, they use the Breyer score. It's essential to understand this metric because it's how the entire system measures truth. The Breyer score measures the square difference between a predicted probability and the actual binary outcome of an event.
Okay, so they use this Breyer score to grade the AI, but how does that actually translate to a readout? If I'm looking at the system's dashboard, what's a passing score versus a complete failure?
Well, you want the score to be as close to 0 as possible. Let's walk through it. A score of 0 means you made a perfect prediction with 100% confidence, and the event happened exactly as you said.
Okay, 0 is perfect.
The worst possible score is a 2. That happens when you predict an event will happen with 100% certainty, and it absolutely does not happen. The math squares your error, heavily penalizing that extreme overconfidence.
So it punishes you for being loud and wrong.
It aggressively punishes overconfidence. And a score of 0.5 basically means you were just guessing randomly like a coin toss.
I see.
To prove you have actual predictive skill, you want to see Breyer scores consistently well under 0.5.
So the AI has proved it can identify the most skilled humans, and it has an internal architecture designed to debate away its own biases. But what happens when you unleash this machine on the absolute chaos of the real world?
That is the ultimate test.
The researchers targeted one of the most volatile, unpredictable assets on Earth, the 2024 Bitcoin market.
That period was an intense stress test. You had Bitcoin swinging violently between $84,000 and $126,000.
Yeah, just crazy swings.
A market like that isn't just driven by fundamentals. It is driven by a chaotic mix of macroeconomics, technical momentum, and pure, unpredictable human emotion.
Here's where it gets really interesting. The researchers took 50 different Bitcoin prediction questions from Polymarket, and they set up a showdown.
Man versus machine.
Exactly. In one corner, the human crowd, the median probability predicted by thousands of real human traders putting actual money on the line. In the other corner, the LLM ensemble, the AI broker's debate system, operating entirely on its own.
And the results were shocking.
They track the results, calculate the Breyer scores, and the LLM ensemble scores a 0.189. The human crowd scores a 0.183. They are statistically practically tied.
The machine, simply by reading data and debating itself, matched the collective wisdom of thousands of humans.
But the real revelation in the paper is what happened next. The absolute best performance didn't come from the humans alone, and it didn't come from the machine alone.
The magic happens in the synthesis. When they combined the human crowd's predictions, specifically weighting the super forecasters verified by the trust score with the AI debate system's probabilities, the Breyer score dropped to 0.167. That hybrid approach achieved a 72% win rate. It significantly beat either the humans or the AI operating independently.
So human intuition and AI reasoning aren't competing forces. They actually cover each other's blind spots.
Exactly.
The paper details what this looked like in trading simulations, backtesting the data over the course of 2024. Strategy 2, which relied purely on the multi-agent debate, generated a Sharpe ratio of 2.1 and a 38.7% return.
Which is an exceptional year for any institutional fund manager.
But when they created a combined portfolio utilizing the AI debates, the human super forecaster signals, and algorithmic technical trading, it yielded a massive 33.1% return with a Sharpe ratio of 2.3.
The risk-adjusted return there is incredible.
It completely beat a simple buy and hold strategy for Bitcoin, taking on significantly less risk and suffering much lower lower drawdowns. There was also a fascinating detail in the technical trading backtest. The researchers found that the classic RSI 14 technical indicator, the relative strength index, hit an incredible 79.4% win rate during range-bound market conditions.
The AI's ability to contextualize the market regime is the key there. The RSI is an oscillator. It measures overbought and oversold conditions. A human trader might blindly follow the RSI in a strong trending bull market and just get wiped out.
Because an asset can technically stay overbought for months while the price keeps climbing, right?
Yeah.
Indicators screaming sell, but the price just keeps going up.
But the AI recognizes the broader context. It knows when the market is sideways or range-bound. In those specific conditions, the RSI ping-pongs perfectly between the upper and lower bounds. The AI knows to deploy that specific tool only when the environment supports it.
So the AI broker dominated the Bitcoin test. But maybe you listening don't trade crypto. The researchers had a broader question to answer. Generalization. Can this system apply its metrics and its AI debates to other asset classes?
This is where the implications of the technology scale up dramatically. They tasked the AI broker with Research Question 3, Multi-Market Relationship Discovery. Prediction markets cover everything from tech and healthcare to energy and geopolitics. The AI was tasked with finding the causal links between them.
So what does this all mean? To me, it sounds like setting up a massive room of dominoes. It's about seeing the first domino fall and having an AI tell you exactly which domino 10 steps away is going to tip over 60 days from now.
That's a great way to visualize it. The system achieved a 67.5% accuracy rate in finding hidden correlations specifically, statistical correlations greater than 0.7 between completely different, seemingly unrelated markets.
Wow.
It maps the ripple effects before the human market participants can connect the dots.
The paper traces some of the exact correlation chains the AI discovered. Let's look at the tech sector. The first domino is a prediction market signaling that the Federal Reserve will cut rates 3 or more times. The AI maps that to an intermediate effect, which is higher overall tech valuations, which it then maps to the final impact, increased enterprise spending on AI infrastructure. Knowing that first domino is tipping gives you a 45 to 60 day advance signal to buy NVIDIA or Palantir, which end up jumping 18 to 25%.
A human analyst often misses those second and third derivative effects until the earnings reports actually come out. The AI is synthesizing macro policy, sector valuations, and specific corporate supply chains instantly.
It found a similar chain in energy and mining. The first domino is U.S. electric vehicle adoption exceeding 20%. The AI connects that directly to a battery production boom. The final impact. Lithium miners like ALB and SQM jumped 25%.
Yeah, the lead time is huge.
The system provided a 90 to 120 day lead time on that trade purely by tracking the prediction markets on EV adoption.
And it works in reverse for defensive positioning too. In the geopolitics chain, the system monitors prediction markets for major global crises. When the probability of conflict spikes, the AI immediately maps the flight to safety, anticipates a strengthening U.S. dollar, and accurately predicts an 18% drop in emerging market equities.
It takes the chaotic noise of thousands of individual bets across the globe and turns it into a clear, actionable map of the future.
Which brings us back to the core tension we started with. We live in an era of unprecedented information overload. Anyone can publish an opinion, and billions of dollars are constantly reacting to those opinions.
Yeah.
What the AI broker paper demonstrates is that this information overload can be tamed, measured, and utilized.
Exactly. By combining the very best human intuition verified by a mathematically rigorous forecaster trust score with the relentless bias-checking power of multi-agent AI debates, we can actually measure skill over luck.
We can finally separate the signal from the noise.
And you don't need a supercomputer to apply this to your own life. The super forecasting mindset is incredibly practical. When you're making a major decision, look for the base rates.
The base rate being the historical average probability of an event happening before you get swept up in a compelling new narrative.
Right. Demand sample size confidence before you trust an expert. Have they been right consistently over 100 iterations, or did they just get lucky once? And most importantly, force yourself to actively debate your own assumptions. Play your own internal bull and bear agent before you commit your time or money.
This raises an important question, one that the author explicitly poses in the open challenges section of the paper. Think about the logical conclusion of this technology.
Okay.
If this scales up, and a few years from now, every major institutional trader is using autonomous AI agents that relentlessly debate each other, eliminate human bias, and perfectly calibrate the odds. Well, what happens to the market? Does the predictive edge disappear entirely in a market populated only by completely rational LLM agents? Or does human behavioral unpredictability, our flawed emotional reactions, become the only edge left to trade on?
It's a wild thought. We build the perfect rational machine to see through the muddy waters, only to realize the mud was the only thing giving us an advantage in the first place. You build the perfect X-ray, and suddenly there's no mystery left to profit from. Something for you to mull over next time you see a sure bet at the top of the leaderboard.